Alright, so we're looking at the dollar index. It's a 15-minute time frame, and I just want to go over some of the points we mentioned in previous recordings. And now that our technical week is completed, the things that we were looking for have transpired. So we move to the sidelines and then we wait. We keep our powder dry. Retail traders will be wanting to push their luck, chase the next move, or if they've missed the setups that we've covered from Friday and what we saw from yesterday's analysis come to fruition, they will want to get engaged, hoping that they'll capture something. We are not in that mindset now. We've accomplished our objective this week, looking for our pounds of flesh, and we'll simply wait until next week to basically stalk another setup. Which will that be? We wait for price to formulate one. All right, so we have the sell side liquidity pool resting here, the market protraction on the downside. Yesterday we saw that, we covered it. I mentioned how we can include the alternative ranges for stop sweeping. Obviously everyone knows I teach a 30 pip, a 20 pip, and a 10 pip. But I mentioned last night in its recording that there's nothing against a 5 pip sweep, a 15 pip sweep, and a 25 pip sweep. And studying price action in relationship to that, and also keying off of the 5 levels or the 0 levels. What is the algorithm presently working with? So we have 15 pips here from the bodies of the candles. We're not looking at the wicks here. The bodies of the candles, 15 pips takes us right down to the very low of the day for the dollar index. The 96.20 level, okay, I mentioned this in relationship to this candle's close. Okay, and it's 96.21.5. So that basically is the institutional 96.20 level. I said if we trade down there, that may be a level to watch. Now, granted, because it's a daily chart, we want to see and anticipate rather some inherent price action. Going back to the dollar index, that 96.20 being on our chart, you can see how we dipped into it and notice the reaction there. This response is exactly 15 pips below this low. Now you're probably asking, why this low, Michael? Why not this low? Well, this low has wicks. It's all wicks. Let me zoom in here. Zoom in a little bit more. I have a very large monitor, so when I was checking the playback, I could have gone in a little bit closer. I apologize in the last few videos. But we have the wicks in here. I'm not really a big fan of that, so I want to look at the bodies because it's going to show the bulk of the volume. Now, 15 pips, and you can see right there, see that? 15.0, well, 15.1, roughly 15 pips, it's good enough. Right from the bodies, lowest open or close, and that's what we have here. And since we have relative equal lows, we know what we're going to anticipate from last night and what we've always been teaching relative to runs on liquidity, a low resistance liquidity run. So we have sell side liquidity resting below these lows, even though it's not drawn up here. It's the same idea that was used to frame last week's analysis for the dollar index. These equal lows here for sell side liquidity. That same fractal exists right here. The same thing. So any rally up, we're going to be looking to fade that. Not that we're trading the dollar, but we're doing it in such a way where we would be anticipating the opposite of our foreign currencies. And since we're focusing primarily on the euro dollar, we're looking for the mirror image, if you will, what we anticipate seeing in the dollar index, and that being a run higher to take out the euro dollar's equal highs, whereas we're anticipating the dollar to run these equal lows. So 15 pips below that, bingo, we have essentially the low of the day. If we look at the open on this candle, we have 96.25, and I'm not going to talk about pipettes. So if we look at the open on this candle here, the open comes in at 96.25 and 5 pipettes. Now I'm going to speak in terms of just 2 digits to the right of the decimal point, because most brokers aren't dealing with 5-digit price delivery. So in the scope of when I say precision, it's going to look like I'm forcing it to be perfect. But if we're using a 4-digit broker, in other words, if it didn't have that last number or that last 5 in the opening price, so it's 96255, normal brokerage delivery would be 96.25, and that's it. So 9625, 15 pips below that would take us to 9610. 15 pips below that for a stop sweep relative to these equal lows for a low resistance liquidity run. The low on the day comes in at 9610. Where do you find this level of precision outside of the ICT camp? It doesn't exist. So we can anticipate specific price runs off of a higher time frame level, 9620 relative to the daily chart. How far below that, Michael? How far can it go down? How can I fine tune my entries? Well, here you go. We have a equal low. Calibrate your stop sweeps on a 25 pip basis, 15 pip basis, or 5 pip basis. What do you get? What was the opening here? It's off of a 5 level, 9625. Okay, so start looking for objectives on the 5, 15, and 25 sweep approach, or use the 10, the 20, and the 30. Either way, you're going to get very, very close to this low. Price responds, runs up. Now we have the same element that we saw here, just in reverse. We have relative equal highs. So relative equal highs, if we run through that, how much can it expand? Well, right away, before we do any measurements, what is this? This right here is a breaker. So price could come all the way back up and trade into that 9660. That would essentially take out all of the stops resting above here. Let's look at the high. High comes in at 9646. So we'll just basically say a 15 pip run above that would take us to 9660, wouldn't it? 15 pips above it, boom, 9660. So it helps us forecast what IPTA may use as future market protraction. In other words, where the market will reach to. Okay, so we can kind of like be like a web slinger. Not to sound too comic book, but that's what it feels like, because you can forecast the next price swing many times right to the pip. So it's an element that helps with your precision and your prognostication. All right, so we've talked about the dollar. I'll quickly talk about the cable, and then we'll do our summary on the euro. All right, so we had equal highs going into today. The opening price, we had market protraction, Judas swing lower. Market structure, break right here. Come back into a bullish order block. Expansion up in the New York session. Pop through shallow right here. Consolidated. False drive lower, like they're going to create some sell-off scenario, and then punched it higher. Right up into, again, using, as you can see here at the high, 130.75. 20 pips above that and or 30 pips above that will get us really close to the high, 131.05. So going to just drop the pip at. So we have 130.75 to 131.05. So 30 pips above it. Again, it's confusing. Take that, cover it up like that. See, it's 130.75. So if you had 30 pips above that, it would be 131.05. And that's what you get right here. 131.05. Now the high goes, I think, maybe 1 or 2 pips above it. Yeah, 131.08 and 4 pip hits. So again, within that variance of 5 pips. So that's kind of like that. I wish I could, refine it to such a degree where everyone's brokerage high and lows and the price would be exactly the same. And that's why it's important that we use the same demo account. And some of you are new. Obviously, you probably are watching videos, and I got to go in there and change it. But I recommend Forex LTD initially when we first started doing the mentorship. And obviously, we can't use that anymore because it's screwed up. I don't even know what the status is on them. But we had issues all the time recent months. So we made a change. Now we're using avatrade.com. And again, I don't trade with live funds, and I'm not telling you to trade with live funds. I'm telling you don't do that. Okay, so that way we can't be mistaking me as an introducing broker, which I'm not. I just like this platform. It was suggested by one of my students. Absolutely love it. It's got all the bells and whistles you would want to use for tracking the markets that we teach in the mentorship. But that 5 pip variance across the brokerage firm, wide array of brokerage firms, it's, to me, I think that is reasonable, because to talk about the high and the low consistently on a weekly basis, on a daily basis, on a session high and low basis, it's phenomenal, folks. I mean, you just don't find that kind of level of precision. So I create this buffer where allow me to be within 5 pips, and I'll give you the high and the low. And it's consistent over and over and over again. All right, so right now, you can see we blew through on FOMC. The equal highs, ran through it, and now we've given up the ghost. Relative equal lows in here. If we lose that, we have to be mindful of this down close candle here. Could offer some support. It may just want to bounce right back up into this structure here. And then this here, right in here, this void has me anticipating a closure there. Especially if we get that pop up in the dollar back to the breaker. We could see that closure here. Okay, so be mindful of that. And now for the brass tacks for the euro dollar. You guys watched me do some trading on that today. I did a scaling in of a total position I wanted to have for the euro dollar. And I used, well, let me get through this part and then we'll talk about that in a second. Relative equal highs, this was the objective for the week. We punched through that yesterday, consolidated. Price dropped down into a order block. Let me zoom in. Okay, price dropped down here into an order block there. Rallied up, consolidated. And again, all of this right here, this is Monday's high. Right back here, this is Monday's high, that blue line. Monday's high, tries to sweep through it, comes back, finds support at it again, rallies through. All through here, okay, all through this declining portion of the market action, I was trying to buy that bounce off of the Monday high. I was scaling in a little bit more, and if it gave me a better price as it got close to it, I'd get in it again. As that procedure panned out, I felt more conviction about how this would send it higher. In fact, I wanted to see it actually trade up to 113.80. I was loving that because I had one of the orders. I put 3 separate orders in, 2.5 standard lots on each one. So it's not a real big position even for a demo. But overall, it's like 75 pips per, $75 per pip movement relative to the leverage being applied. It's a 6-figure demo account just like you guys have here, so it's not a big deal. So I'm not trying to trade with ridiculous leverage. I'm just showing you the amount of pips that comes by way of using what we learn. The price action took a little bit of time, which is expected on FOMC. This is the reason why I say that you should not be trading these days. Now, I did it simply to show off on Twitter and to come back and show you, again, one more evidence to what we learn here is set apart from everything else. We know there's a liquidity pool resting above here, so the buy side liquidity pool resting there. During FOMC, right there, creates the high of the day, whoop, down in. Relative equal lows, again, think like I just mentioned on the cable market. We have a liquidity pool resting below this low here, and we have a small little area right in here. This is where my eye is going. And I'll tell you in a second why I think this. If we drop down This isn't so much a problem because it goes back and forth with the open and close and the lows and the highs. There's more efficiency in this area than it is here, between this low and this high. I like the overlapping of that with this series of down close candles. So this is a bullish order block, and we have a little bit of a gap in here. So I really, really like that. So I think that's going to be in a discount array that we want to be watching. And it's essentially the 113.10 level. Even though it says 113.7, I like 113.10 because it's a round level, round number. So let's put that on our chart so it's germane with our discussion. All right. And that's that. Now, obviously, with it being here, I'm allowing or anticipating it going down a little bit further to close this in. If it gets there, it doesn't have to get there. And I don't really care. Right now, I'm just analyzing it the rest of the week. I'm satisfying the analyst in me. The trader has been satisfied because of the executions. The previous weekly high, we've traded through it. Watch. Ready? We go through it here, 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 and now we're back below it. So if we break this low here, we really should start seeing some movement lower to get down into this level. So what we do after that, trading to this level here, I'll have to see what we see in terms of how's it trade there. Like, how is the price action in the sense of what is it doing, the speed, how fast is it traded, what time of day. All those things will help me formulate an idea. And I already know what you're going to ask me. What things would you be looking for, and what would constitute one form of a setup or not having any action. There's so many variables to that. That's why I'm just telling you, you have to be patient and wait for me to see it, because it's not going to benefit you to give you a dozen different scenarios, because again, that's like plan B, plan C, plan D. I don't do all that. I don't do that. I know what I'm looking for, and when it's there, I tell you, and the price gives it to us. So it is what it is. But that's going to be it for today. A really simple little exercise. You guys can look at the Twitter account and see all of the executions. I recorded as much as I can inside of like 45 minutes. That's all I give you for Twitter for recordings. But that's the business there. Let me quickly pop over to crude oil. I tweeted this again. We're almost at that 58 level I talked about mid-January. I like that. And here we have this small little gap here. We talked about that again, January time period. And if you go back and look at the recordings in the mentorship, I think I did some discussion about what this is over here as well. And gold. Gold gave back a little bit. If we see that rally up on the dollar index up to that breaker, we could see it come back down to this high. It's actually better if it doesn't do that. I'd like to see it just come down maybe just a little bit past the equilibrium of this range, which is what this line here is indicating. But if the dollar really takes off, say I'm wrong, and the dollar just finds a runner and wants to go higher, this could be a significant high or intermediate term high, and we'll have to contend with these equal highs later on in the year. Okay, so that's something to consider. But this has been a really nice run on gold, and if you are in it, I would counsel you to take something off, pay the trader. And that's going to be it, folks. I will talk to you by way of Twitter tomorrow. And until I talk to you then, I wish you good luck and good trading.